Now, we know that the eyes of the country and indeed the world were on the markets this week, and it certainly wasn't good news for many of us. In fact, we have some economists and columnists warning South Africa that the price of living in the country is probably going to go up, and government, Treasury, the Minister of Finance are going to have to do a lot to tighten government's belt to ensure that we're at least buffered from some of the international financial storm, they're calling it. From your perspective, from an investments perspective, what are we experiencing at the moment?
Well, the first thing is to understand what an investor is. So by definition, if you're investing, you have some future goal that you are saving towards. And that should be relatively far away. So you've got to be 5 years and longer to be an investor, because if you're less than 5 years, then you're not really an investor, because the financial markets have always been unpredictable, as we're experiencing now. So the first thing is be very clear what your objective is. And if you're investing, so let's say that I'm investing either for my retirement, which could be 20 years away, or my child's education, which could be 10 years away. My goal is to maximize my investment value at that end point. And you have to put a sensible strategy in place that's going to get you to that goal with accumulating the most amount of money. And that's a long-term investment strategy. If, on the other hand, you need your money in a short space of time, well, what the current environment shows us, and what we know from previous market environments, is that the short term is very uncertain. So you have to really clarify in your own mind, what am I investing for? So that's the most important point. And as you say, when the markets are weak and the currency is weak, we feel depressed. No one feels good when they see red in the stock market and they see the investment value less than it was a week ago. But that's why context is important, because when did you start investing and what is your goal? So to give you an idea, if you started investing in 2008, before the financial market crisis, where the South African stock market more than halved. So that was a much worse environment for investment losses and panic and hysteria and all those other negative emotions that followed. So your portfolio would have fallen quite a bit, but it would have more than recovered. In fact, if you look at one of our high equities, our long-term balanced fund, it went from a value of 107 down to 84. So you had about a 22% fall, which is large. Why didn't you fall as much as the stock market? Because you diversified. So you don't only own South African shares, you own property, bonds, you own some offshore, so you cushion from that. But then it subsequently recovered dramatically. So by the end of July, it was back at 250. So you went from 107 down to 84, and had you hung in there and not panicked and not done what unfortunately most people do, is your money would have gone up 2.5 times. And what we've seen now is a relatively minor correction. Yes, it has happened in, as you say, quite a short space of time. But even since then, what happened is that our portfolio fell by about 7%. It's recovered because the markets fell a lot and they've come back a bit. So it's important to understand why you're saving, what your long-term goals are, and not to panic in the short run.
I think what you're saying is so important, because when many South Africans saw their portfolios falling, I think many South Africans were tempted to remove money from investments because of the unease that goes with it. I know in recent interviews and recent surveys have shown that South Africans are cash strapped, and it's very difficult to put away that money on a month-to-month basis. And when you make that big sacrifice of being disciplined enough to put away a portion of your income into some type of investment, seeing that portfolio fall is certainly a scary thing. But your advice then is to not panic right now.
Without a doubt. So you've got to, as I say, always have your goal in mind. And the goal is really to maximize the end value, not the value next week or next month. Because if you try and manage your money on a short-term basis and you listen to all the market forecasts and you see the volatility, you're going to make a short-term decision. And short-term decisions are going to give you bad long-term outcomes. So that's the mindset you've got to understand the goal. And a sensible long-term investment strategy is exactly that. It's a plan that is almost like an all-weather plan, because the one thing that people should know is that you're going to experience volatility. You're going to experience bad periods. You're going to experience periods where your portfolio falls, where the currency falls, where there's doom and gloom. As a long-term investor, if you go back in time, you've seen that we've had these periods. Not that often, but every 5 years or 6 years you tend to have a lousy period. So if you're not prepared for that, It's really about expectation. So if I don't expect something and it happens, then all of a sudden I'm shaken, but you should expect that. And also, if people have been saving for a few years now, what they should notice is that they've got a lot more money today than they had 2 years ago, even though the markets have come off a little bit. And that's the whole trick, is to invest for the long run and don't get emotionally involved and make illogical yet emotional decisions.